This is the Gray Report, your source for the best news, research, and reports on multifamily, commercial real estate, housing, and the economy. I am Matt Bastnagel, to be joined in a few minutes with the usual host Spencer Gray, but we are blessed today to have on as a guest Jay Reeder. Jay Reeder is the Chief Investment Officer at Gray Capital. Thank you so much for coming here. And let's just check really quick. If I could Google it again and refresh, it's 2:01 now, and there should be, you know what, we're going to...
I think I saw one down there, someone saying 50 bips.
Feds cut rate by 50 basis points. This was the expected rate cut. That's very interesting too, because I was going to guess that it was going to be a 25-point basis cut, and my reasoning was because it's purely psychological. He loves to be the hawk. He doesn't want to be the dove. Wants to have something else to hold. But yeah, what was your take?
I thought they would probably go a little bit heavier on the initial cut, and then I kind of today have been keeping an eye on Chatham and looking at kind of the forward look and what it's doing with kind of rate caps and what the pricing of that, and pricing on that has virtually not changed for 2 weeks.
Yeah.
And so I think that most of the people had whatever rate cut kind of priced in on that, and I hadn't seen any.
So when you're talking about rate caps, what so this is when people are kind of hedging against higher interest rate cuts? Higher interest rates. Yeah.
No, so the reason I've been kind of spiking against that is, so we just bought Solana, and on that we had to buy a rate cap because we assumed a floating rate debt on that.
Yeah, yeah.
And so I, in my head, have known what pricing on that was, and pricing on that is based off of the SOFR futures. So I've been kind of gauging as this announcement's kind of coming, okay, how much has the market been moving relative to that? And I think for the last 2 weeks, it's since it dropped a little bit over Labor Day weekend, and then kind of since after Labor Day, that is held pretty firm. So I was checking right before I came on here to see if it had jumped up or down, and it's been same all day today. So I think the market had pretty much priced in that 50 basis point cut.
Interesting. So, I think that seems a little bit more meaningful to me than... Now, I like the Fed Watch tool. They gave a 55% chance that it was 50 basis points and a 45% chance that it would be a 25 basis point cut. And looks like it was slightly that the 50 basis point cut won out, but I wonder what the difference is between that and I'm watching for rate caps, because it seems, I guess in both cases there's money on the line. They're both kind of driven by the futures markets and stuff like that. But I think that this is good news. I'm wondering what the psychological reaction is, whether it is going to send markets into a bout of overabundant enthusiasm, or whether it will be business as usual. Maybe they did price this in a long time ago, but I don't know. How is it going to change? My question for you is, how would it change kind of day to day or going forward? What do you think is going to happen in the multifamily market? And
I mean, there's lots of answers to that question. I think the easiest one, and if you talk to any broker that's trying to sell a deal, it's like, well, interest rates are going down. We can sell for a lower cap rate. And I think one of the things that here at Gray Capital we have really been looking at over the last couple of years since kind of the run up in 2022 is, what is the difference between the value of the property and what is the value of the property as a kind of financial product, so to speak? Because a lot of the time we made money, especially when rates were super, super low, is that difference between the interest rate that you could get on the loan and borrowing against it versus the cap rate or stabilized yield you were buying the property for. So having that spread there is kind of where you made your money. In 2022, as rates started going up, all of a sudden interest rates are above where cap rates were. And there was that huge period of where there was nothing moving in the market because sellers still wanted those lower cap rates. And everyone's like, my money's cheaper in a 30-day money market account that's based off of SOFR or based off of some other product. And so then what got really popular were these loan assumptions. And the loan assumptions like, well, let me sell you this product that's got a 3% interest on it. But they were selling it for a low cap rate, and they were trying to still, again, just sell the spread between what the interest rate was and then what the cap rate was. But then you were getting these crazy valuations on the basis and what the real estate itself is actually worth. So maybe you were clipping a coupon and you were making money with that little bit of delta there, but then on the back end, when you have to go sell the product, you've given it this oversized valuation, and then it's harder to make your money on the back end. So you really take away that appreciation aspect of the property. Now in the last, I would say, year, we've kind of seen ebbs and flows of sometimes as rates have kind of ticked up or ticked down for a month or two at a time, people maybe are able to time it, but it's not really a business strategy timing the market. And so a lot of talk I've had with people in the last couple months has been, hey, we all know rates are going to go down. That should justify some of these lower cap rates, but it doesn't solve for the fact that that's kind of financial engineering the value of the property if some of the other basic fundamentals aren't there.
Yeah. Well, and it's also like 0.5%. How much is that really going to matter? Does it matter?
It does matter because any little bit, like if you are taking a property and you're levering it, call it 65% debt versus 35% equity, maybe that 0.5% gets you from 65 to 68%.
Yeah, okay.
And then all of a sudden now you're taking that little bit.
That's the crazy thing too, is like the tiniest of interest rates is like it moves the money so much more in the other direction.
Well, and it moves money because everything right now isn't, almost anything you underwrite right now is not loan to value constrained. It's debt service coverage ratio. And so all of a sudden, those little bits of movement on the debt all of a sudden allow you to have kind of that expansion there and all of a sudden size up maybe more.
5%. How much is that really going to matter? Does it matter?
It does matter because any little bit, like if you are taking a property and you're levering it, call it 65% debt versus 35% equity, maybe that 0.5% gets you from 65 to 68%.
Yeah, okay.
And then all of a sudden now you're taking that little bit.
That's the crazy thing too, is like the tiniest of interest rates is like it moves the money so much more in the other direction.
Well, and it moves money because everything right now isn't, almost anything you underwrite right now is not loan to value constrained. It's debt service coverage ratio. And so all of a sudden, those little bits of movement on the debt all of a sudden allow you to have kind of that expansion there and all of a sudden size up maybe more money than you would think based off of the ability to have that NOI ratio in a better situation by, call it 50 bits.
Would lower interest rates mean that you could get a bigger loan to value, or are they independent of each other?
I think it's not independent of each other, but what a lot of people would say is you could get a bigger loan, but by getting a bigger loan, if people were assuming getting 65% loan to value before, we can get that bigger loan, but it's still going to be 65% loan to value, and it's just going to push the purchase price higher.
Oh, okay, all right, got it.
So I would love, in my situation, I'd love for the purchase price to stay the same place and be able to get that little bit of extra leverage.
Yeah. So before, I remember it wasn't 65%. It was closer. It was a little higher in like 2 or 3 years ago.
Oh yeah, there have been times where you could get 70%. I mean, and there are still opportunities where you can still do that in the market.
Yeah.
But I would say kind of your stabilized kind of run-of-the-mill deal, if there isn't like a value-add component or some other things where a lot of times some of that better leverage comes on bridge loans because you're going to like a stabilized exit rate, and so they're being maybe a little bit more aggressive on kind of your bridge financing. Now, a lot of that has come in a little bit because of some of the risks in the market, but I would say where you saw a lot of that kind of pushing leverage was on bridge loans kind of in the 2020, 2021 period, and then kind of pulling back. I would say I've maybe gotten a couple of between 65 and 70, but I would say for the most part, 65 is kind of what I'm seeing everything sized to in the market right now.
Interesting. I am wondering, so I just have the Federal Reserve live. So their press conference is going to be at 2:30. We just reviewed, the big news here is the 0.5% basis point cut. And I am very interested in what this is going to mean in terms of like deal activity, and is it going to make people come out of the market and want to sell or want to buy and think that this is a good environment right now, or are they going to wait till 2025 when maybe there's another 1 or 2 interest rate cuts? That's what I'm super curious about, is how this is going to impact market activity, because I feel like there is a certain amount of people now, not all of them, that aren't going to go on the Excel sheet. They're going to go on what they think the future is going to be instead of like what it is now. They'll speculate a little bit and try and get ahead of the market.
I think that your answer, or the answer to your question, is kind of in what have people been doing to this point? Because we've seen a lot of activity in the market. I wouldn't say a lot, but we've seen activity in the market. It's not like there have been no sales for last year. We bought 2 this year. And I think people that are convinced future values are going to be have been active in the market previously and have been kind of stacking deck ready to go. I do think that there is going to be a pretty quick flood to market with some money of people seeing interest rates coming down and being like, okay, I don't want to miss the boat. I mean, we've even seen that in some deals that we've gone after recently that I think people really want to go after quality. And so I've seen some deals that they come out, there's some initial kind of pricing guidance, and sometimes it's there, sometimes it's a little bit short. And I would say probably for about a year, I saw almost all deals kind of coming up short. Like, it didn't matter what deal it was.
Like almost, below the whisper
below
price.
What the whisper price. Almost everything came in below that. I would say in the last 3 months.
I would also say that maybe the whisper price is a little too big.
but I think
6 of 1,
what's happened now is maybe we've kind of found that equilibrium, because I would say that in the past 3 months, I have seen deals that have both gone above and below whisper price. But I think the big differentiation on those is vintage and quality of asset or quality of location. I mean, the new construction, maybe 2018 and newer and growing areas, I have seen those far surpass whisper price in the last 60 days.
Wow, in the last 60 days. So, and that's something that Spencer has talked about too, is really within the past month or two, things took a dramatic turn. It seems like a lot of people realized this at the same time. I still think that there's another inflection point coming to where things really start to shift, and where everyone's just like, yeah, now I'm kind of more excited. And it's like, all right, well, talk to me a month ago and that would have been a little bit easier for us, but we did get that funded. But I wonder if it's going to be easier to get future investment projects funded, because the general investor sentiment of not the average Joe investor, but like the average multifamily investors, probably going to see lower rates and be like, oh yeah, actually now I'm more willing to.
I think where that has come is we've known that rates are going to be cut for a while. We haven't known exactly what it is, but we were given indication that rates were going to get cut. And so all of a sudden, a lot of people, and even myself included, like when I'm looking at how I want to invest money, stuff like that, it's like, okay, I could invest here, I could invest in the stock market, or like I could put my money in a money market account and kind of see which way the wind starts blowing once the money markets aren't 5.5 anymore, because we kind of all knew they weren't going to be. And kind of with that shift in philosophy about a month ago, us knowing that shift is going to happen. All of a sudden now people are like, okay, now I need to start deploying, because I'm not going to get 5.5 in my money market account anymore. And so I think that's where maybe the shift is kind of coming from, is now that we know that it's no longer going to be these high yields on bonds, money market accounts, all of that.
So an alternative.
It's like, okay, do I need to get back in the stock market? Do I need to get into alternatives? And now we're seeing those people like, okay, I can't just sit in cash anymore. Where am I going to put it to? And I think that's where a lot of that shift has come, is kind of now that it's been signaled, you're not going to get that anymore. People are starting to like, okay, now I really want to think about where I want to put that money.
Yeah, I just think that there's something about the fact that it happened. It kind of makes it real. Before, especially if you are risk averse, you're going to want to put it in. You have it in the money market account, period. And so there may be some people that are waiting for the sure thing. The sure thing has happened, and now, now let's see. Do you think that this will result in any increase in deal activity towards the end of the year? Now, I know that this is a strange moment, almost maybe an anxious moment for some multifamily syndicators or buyers and sellers trying to get the last deal in before the end of the year. Is this going to have any impact on that, or is it going to be kind of same old, same old? I know last year there wasn't really a rush to the exits, nor was there in 2022. It was like,
I think it's kind of going to be business as usual. I think. And a lot of that has to be maybe not necessarily whether people are buying or not, but I think at this point, if you're going to sell by the end of the year, the deal has to be on the market, or like in preparations to be in the market. So even if there's lots of buyers ready to buy a deal, there may not be deals for them to buy. And so I think that's kind of where the rub maybe is. There may be a lot of people that are looking to place money and looking to put money back in, which is maybe why some of those Class A deals that we have seen lately have gone up significantly in value, because all of a sudden people are looking to place them, but people can't place money if deals don't exist. And so what I think is probably what you're going to see is, because of this, maybe some people who are holding on to deals waiting for that turn maybe Q1, Q2 next year are going to bring those out. And then you're going to see, okay, what people go after what types of deals.
Okay. Yeah. Interesting. I'd like to get into a little bit now. I know that the Federal Reserve press conference is in 15 minutes, but I think we kind of covered a little bit about what the impact on the market might be. And I'm going to throw a little bit of an audible here and show this article that we have from Apartment List. It is on millennial home ownership. So, millennials, as Rob Warnock writes here, have developed a somewhat difficult or a somewhat unique reputation for struggling in the housing market. To that, I respond, yeah, that's true. I think it's pretty abundantly true. And millennials came of age during the Great Recession and the attendant housing crisis, and while Warnock rightly notes that millennials are actually the third consecutive generation to purchase homes slower than those who preceded them, it does seem to sting a little harsher for the millennial generation compared to their older forebears. Yeah, boomers and Gen X had some share of their struggles owning a home, but now Jay, I'm glad you're here too, because I'm about to butcher a Dark Knight Rises quote. Millennials were born in the darkness. They were molded by it. They didn't see light until they were already a man. It took them a while. They know the sting of unaffordable housing a little bit more than I think the older generations do. The great financial crisis of the late 2000s left that lasting impression, and I think a real cynicism towards the housing market. And there's no stats about their feelings right now, but there is stats about their home ownership rate, and it was significantly lower than previous generations. Rob Warnock does show us a very interesting wrinkle in the millennial housing narrative that almost goes against this narrative that we're talking about. It looks like if you are fixing for same age, millennials are almost intersecting with Gen X. So same age Gen X. So the oldest millennial group is 42, 43, something like that. Now, when Gen X's were 42, 43, they were owning homes at about 60%, and millennials are owning homes at about 60%. This is the only real time in this. Now, this chart right here, just for the listeners here, shows home ownership rates as a specific generation ages. So home ownership rates when the silent generation was 40 was over 70%. Well, the home ownership rate for Gen X when they were 40 was under 60%, and so on. So each older generation has higher home ownership rates for that same age. I think the notable thing, and they don't really note this that harshly, they're focusing here on, millennials owning homes slower, but we could intersect with Gen X. We could have higher home ownership rates for the oldest millennials more than Gen X. Now, the caveat to this would be, I think so, as the millennials age, that 43 or this line that we see almost intersecting and could go lower, because the average of all the millennials right now, we're only measuring these millennials that are 42 are practically Gen X's. So that I think that kind of skews things just a little bit. However, I think that it's a really interesting point here, and it showcases the rapid effects and the rapid changes in home ownership during the Great Recession and during this most recent recession and pandemic. It's really striking to see, and at any rate, it's good news to see this uptick in millennials owning homes, and it's instructive to see exactly which housing-friendly cities they are owning homes in. So we have a list here of home ownership rates by metropolitan area. And one thing that is incredibly notable is the top 6 here are all in the Midwest. And they all are well above. So the average is 45.5%. Now, these top 5 in the Midwest are well above that average, above 50%. Minneapolis, Minnesota, Grand Rapids, Michigan, Cincinnati, Ohio, Louisville, Kentucky, Indianapolis, Indiana, St. Louis, Missouri. Now, just a side note here, Apartment List is counting Louisville, Kentucky as a market in the Midwest. Technically, according to the U.S. Census Bureau, the state of Kentucky is in the South and not in the Midwest region. But I think it's totally fair to claim Louisville as Midwestern. For one, it borders a great Midwestern southeastern state of Indiana. And for two, it's actually, the state of Kentucky is already farther north than Missouri. So, and Missouri's in the Midwest, so I think you can count Louisville. So that's my stretch.
It's a borderline. Now, one thing I want to touch on, if you go back up to what we were looking at before, and look at where millennials were in relation to Gen X, notice on the last couple of years on both millennial and Gen X, though, both of those ticked up pretty starkly. And I think one of those things that I've talked about with Spencer before, and I think we'll kind of see it, is I don't have proof of this, but this is just me thinking through it. I think we're starting to see some of that, what they're calling the great transition of wealth. Because in my head,
that's the first thing I thought of too.
My head, I'm looking at, I'm like, how many millennials are going to go buy, or not millennials, Gen X's are going to go buy their first house, or percent of them are going to buy their house at age 58. And so in my mind, it's probably not going and buying a house. It's probably you're inheriting a house. And so I think that you're starting to see some of that transfer of wealth specifically kind of in those numbers. But like, as I'm looking at the percentage of people when we're going back to like 30-year-olds and all of that, I would say that that's a much kind of different calculation, because I would say that gap at a 30-year-old is a lot wider between millennial and Gen X than Gen X was to baby boomer, or even baby boomer to silent generation.
I think that if you want to look at that, I have here the home ownership rate in general for all of the populations. Now I also have a nice handy graph that groups it out by age group, but that's cheating. That's I'm going to introduce that later. So this is overall home ownership rate, not separated by the generations or anything. Because I also, the one thing that this apartment list graph does not do is illustrate the current picture and the current environment of home ownership at a given time. It just tells you what ages in what generations. You have to look at the inflection point in the millennial in the same place as in Gen X. You kind of see it at the end of the Gen X line. You see it like dip down and then spike up. You see it dip down in millennials at the same point when they're 40, because that's what happened in the past 5 years. Well, you see that same thing. It dips down and it spikes up for the overall home ownership. So I think that some of it is like a generational thing, but I was struck by, the actual spike in home ownership rate was in 2005, right before, a few years before the Great Recession, and then it went all the way down to. So I'm sorry, the peak was 69.2 in 2004, and it went all the way down to 62.9 in 2015. And ever since then, it has been kind of generally trending up. I'm excluding right now the big spike when it went up, like 2% in one quarter during the pandemic. Everyone was buying a home, but then it kind of settled down a little bit, and it's continuing a broad path upward, the home ownership rate. And right now it's kind of hovering around 65, 66%. Now, what I also think is notable in Q1, there was from Q1 to Q2 in 2022, there was this small spike in homeownership rate during 2022. I think people were getting in before the rate cuts.
Well, and I think one of the things that I just find interesting, and I question a little bit on this graph, is this is percent of home ownership. So how did we get a 2% swing? I mean, in 2020, that's 2% of the country were owning more homes during COVID. A lot of people that locked in rates at COVID probably are still sitting on them now, because that's what has caused the price to go up on so many single-family homes, is because everyone locked in those 2-3% mortgage rates, and they're not moving. And so one thing that just kind of, to me, seems like an outlier in this is I don't feel like 2% of the population sold their homes and moved out of houses over one quarter. I think that there are people that would like to get into, and I think that's where we see in our kind of industry of maybe there are some retirees that are selling it and going, and then obviously you have the generations that are kind of matriculating out of colleges and getting into the work balance, and they need to have some place to live, so where they're living in apartments, and maybe they're doing it for mobility. But in an area where supply has been so constrained on the housing market because people don't want to sell because they have this great low interest rate, I would be surprised that it would in a quarter move 2%.
Yeah, I agree there. And for all we know, it could have been like the reporting was wonky at that time because there's a lot of these graphs that they just have a gap in certain times during the pandemic because they just couldn't gather that data at that point. But to kind of return to the apartment list article, they do talk about these regions. Now, I mentioned them before, how the Midwest is outperforming other ones. The Midwest has these above 50%, whereas if you go all the way down to the lowest one, the lowest homeownership rate is in Los Angeles, California at 20%, less than half the average, definitely less than half the average of these Midwestern markets. But there is a clear bifurcation between the Midwest region and the South and the West, and you can see it in the map they have here, which shows now it is nicely color coded, and it is color coded in the same. I have 3 different maps for you this week, and they're all color coded in the same way, and they all illustrate how housing costs in the West and in the Sun Belt, the American South, are way higher, and it's super easy to see how low they are actually in the Midwest. So places like Indianapolis, Carmel, Anderson, they have an above average home ownership rate. Now, I'm using this also as a proxy for home prices because if you look at, here's my second great map here, same colors. Now, of course, this is loading because same colors. It's blue in the Midwest, it's red, and these warm colors in the South and the West. The low home prices are directly contributing to higher home ownership rates. I think that also things like job market, maybe a stable economy, you've got to have that stability maybe to own a home there. But largely, this is a product of home prices. And my open question then is how might this affect things in the future, and how might this affect migration trends? I'm specifically, I'm openly wondering whether people are going to move to places where the housing's cheaper, or is it really like that doesn't really happen? I know we're past this point of the remote work boom where everyone was able to move anywhere. They could move to like Asheville. They moved to all the cool like woodsy areas or beach areas, and that ended up boosting the housing demand now. But it's also, I wonder if housing affordability will be so expensive where there will be a meaningful effect of in-migration into more affordable Midwestern cities. So I know you got to have a job, right? You're not going to move somewhere if you don't have a job, for the most part, but maybe you open up Indeed or LinkedIn or whatever, and you filter by, jobs available in Grand Rapids or jobs available in Indianapolis, and you start looking for them and figuring out to move. That's not out of the question.
It's not out of the question, but I think it's all going to be relative because if you think about we've kind of seen this swing on remote work, where obviously, like you said, people went fully remote and could go anywhere they wanted to. Go to the mountains in Montana, go to Asheville, North Carolina, and you could work about anywhere. But then now, as you've kind of seen people kind of reduce that work from home, I mean, I think I saw an article where Amazon intends on ending and being in 5 days a week. So all of a sudden, you're going to go where Amazon is because you're going to go where the jobs are. And probably in locations, I don't know that you're going to necessarily go where housing is cheaper, but you're going to go where housing is more affordable relative to what you make. And I think that's one thing that sometimes when I look at these maps, I don't always have a good answer for what the housing cost is relative to what you make.
That's a really good point for sure.
Because it could be cheaper. Like my hometown up there is in one of those areas where it's more unaffordable.
Let's put it up.
In Lafayette, but I know houses aren't super expensive in like kind of Northwest Indiana relative to where they are in Indianapolis.
Lafayette has 43% home ownership rate, and if you go into how much it costs, it is Tippecanoe County is $287 compared to Marion County, which I'm not really doing great on this here. Oh wait, Marion County is $250. So actually, okay, that's interesting. So
but I would say your jobs, like because you have larger law firms, you have larger hospital systems. So some of your higher paying jobs are more of those in Indianapolis, and maybe they're in Lafayette. Now, the difference with Lafayette is Lafayette has Purdue University. And so with the percent of owner occupied homes, that's a big college town. So there are a lot of people necessarily that may not own their own homes because it's a pretty big rental market due to the college town being there. Oh, are we getting ready?
We got a press conference. I'm going to throw up the window here. I've been wrong about which is the small window and which is the full screen. All this live stream, but I think I've got it mastered here, and we're about to hear the comments from Federal Reserve Chairman, the one and only Jay Powell.
Reduce the degree of policy restraint by lowering our policy.
All right. Jay and I shared a little bit of. I don't think we'll be able to cover some of the stuff that I wanted. I just want to talk about the Fed, if that's all right with you.
Yeah. Let's talk about it. Let's talk about some of.
So my takeaway is it seems like and then this is just kind of playing off what he just said, is tone of kind of reassurance about the economy, and he wants people to know that I'm not doing this because I'm scared of the economy. I'm doing this because it's getting to a normal point and interest rates are abnormal. We want to dial that back to normal.
Yeah, I think that's a good way to put it. Is right. This was the appropriate move. You heard Jerome Powell say that they could have gone with 25 basis point reduction in July, but they just ended up not doing that.
Yeah.
And so they're really trying to get the current Fed funds rate where moving in the direction where it should have been. In a sense, that's an admission that maybe they're slightly behind, but then kind of in the next sentence he said they're really not far behind, and this is kind of getting them right where they need to be, and stating that the balance between inflation and employment is at a healthy equilibrium right now, and that this the direction of travel for rates is lower, as in the direction of travel for inflation is lower, and that we're in a pretty good spot, and even saying that the chance of a downturn is not elevated. Now, I think it's worth noting that they're going to overemphasize the idea that the economy is on somewhat solid footing, because they have to counter the idea that 50 basis point reduction in rates is extreme. Now, looking at so the probabilities and how the markets were pricing things in, they were pricing in 50 basis points. This morning they had been for a couple of days now. So. In terms of markets, it's not as shocking as it could have been. But I mean, I was having conversations, as Jerome Powell came on the stage and with everyone, and even I said, this morning when we were talking about it, I just can't see them going more than 25 because it's going to be a little bit of a shock to markets. But what will be interesting to unravel is some of those leaks to the press, to the Wall Street Journal, and some other outlets last week, indicating that 50 basis points may be the decision. That was somewhat discounted, although it did start moving markets. But that was in that blackout period, and this idea of should kind of back channel leaks be an appropriate tool to communicate monetary policy to kind of prime the market for the move. That seems like what they did, and very irregular. Some would maybe even say inappropriate when they're supposed to be kind of in this blackout period.
Because it's favoring who they leak it to. Automatically,
it's favoring it. It's favoring the outlets, which I think less people care about. Care about that, but more of just saying, if you're going to communicate this, be a little more clear about it, because you are giving preferential treatments, not just to that outlet, but for people who are taking those leaks as seriously and making investment decisions. While others are like, no, we're in a blackout period. I'm going to go off of the data that we have. So definitely controversial. Matt, I have to get into they talked about housing not the whole time, but it's definitely a top priority. Now the Fed admitted there's only so much that they can do for housing, but made it very clear there's not enough housing in the United States. There's issues with zoning and regulatory issues. Did not mention a need for rent control or getting rid of RealPage or anything like that, the things that have been discussed.
He noted market rents, how market rents were stable. I think that conspicuously absent was the fact that home prices are like 5%, maybe 5.6%. Inflation. So like that the source of this shelter inflation if you're factoring in that we have zero market rent growth, is home prices, and I don't think that a lower federal funds rate is going to affect that. He even kind of seem to allude to that as like, yeah, you're going to sell home. It'll make people want to sell homes, but then it'll also make people want to buy homes as well.
You're selling your house, move into another house, but you've been kind of prevented from doing that because of rates. Just looking at the 10-year Treasury rate, Matt, the 10-year Treasury is spiking right now, back up to 3.69%. We were all the way below kind of 3.5%, I believe, earlier this morning. That's not incredibly shocking. Folks are, they're essentially they're selling off right now.
Yeah. I would like to ask you one or two of the same kind of question that I asked Jay when we learned that it was a 0.5% basis point increase. What if anything do you think this is going to have effect on the multifamily market, on investment appetite, on the deal flow that is going to happen through the end of the year? I'm not talking about what happens in 2025, because I think it's really going to ramp up in 2025. But is there going to be an immediate effect of people that are trying to like get ahead of it or get their deals in before the finish line? Jay seemed to be a little bit skeptical that anyone would have time to get their deals, or do you think now that like
before the end of the year?
Yeah, before the end of the year, or is this going to affect deals that are currently being marketed? I am curious. Maybe if this decision was made a month or two ahead of time, maybe if it was made in July, if that would have had a material effect, I would guess that it would result in a measurable increase in investment activity in buying and selling, because people just kind of want to get ahead of it, and this trend is real in a way. Now, and again, Jay also was noting that people had been factoring this in. This has been a part of people's thinking for probably like 2 months. He cited the increased activity, but I think that there's something about it actually happened. It makes it real to some investors.
I think you've got a good point. I think you and Jay are both right. I think that this certainly was starting to be priced in, and now it's truly priced in. And an acceleration. What was, while we're saying the 50 basis point was priced in, I mean that was priced in the bond market, not necessarily priced in the multifamily market. Now the multifamily market, it's a little bit kind of broader and kind of duller, kind of blade, in the sense that it's not as exact of where the rates are going to go, just more of in the direction of rates are going to be coming lower. And I think that's the incentive to multifamily investors right now, is if we're looking at an environment of where interest rates will be reducing over the next several years, there is a correlation between interest rates and cap rates, because that cost of capital you're paying on that mortgage is the most amount of costs you're going to have in terms of in your capital stack. I mean, it's making up anywhere between 50 and 75% of the capital you're bringing to the deal, and that cost of capital is incredibly important. As that cost of capital comes down, you can end up paying more money, which drives cap rates down as well. So just the price of assets, and so folks buying right now are trying to get ahead of that. And the challenge is, and we've discussed this, on multiple recent episodes of the Gray Report, is that the rate of growth today in terms of rent growth is anemic. It's negative in some markets. It's zero in others. It's a little bit positive here and there.
Yeah.
And the most rent growth you're seeing in a market, I mean, there's some outliers of 5-7%, and Portland, Maine was one, and a couple other random spots. But typically, like in a strong market right now, is like 1 to 2%.
Yeah,
if not
exactly.
zero.
Yeah.
And so that doesn't look attractive on yields going forward. If you're buying a property, what kind of cash flow is going to throw off this year and next year? You're not really being able to see great cash flow, because while interest rates have been coming down, the 10-year Treasury, 3.69 as of right this second, much lower than the fours that it was a couple months ago. But the prices are going up. And so as cap rates come down, you're having to pay up. And I think cap rates may be going down faster than interest rates will come down. I mean, as we've seen, the 10-year Treasury is already up today. Right. There's going to be some volatility without a doubt. But we could be entering into a period that almost reminds me of the period we were in 2023, when just the pricing didn't make sense. Now, you can make the argument that the latter half, and especially the last quarter of 2023, the pricing may not have made sense, but you were starting to see sellers come off that high price, be more reasonable, and some great deals were had in that kind of the last quarter of 2023, kind of in the first 2.5 quarters of 2024, and now prices have started to go up. So do you bet on that you're going to see some strong growth as supply is reduced at the end of 2025 into 2026? Cap rates are going to come down, so you'll see some significant appreciation, and then a multiplier on that appreciation. If you can get some strong rent growth and increase your net operating income, you could be in a really good spot. But that's a lot of speculation compared to the normal of we're going to get a decent interest rate. We're going to start off with some solid yield. It's not going to be gangbusters, but some yield that you're happy with. That if you can't get any more rent growth, we're okay with these returns. And then you're kind of hoping that you're going to see some organic growth over time. But in this scenario, you kind of need to see a little lift in kind of 2026. And if you don't get that, instead of being okay with 6, 7, 8, 9% cash on cash, you might have to be okay with 3, 4, or 5% cash on cash. A lot of investors, that's not enough income to get them excited about the deal. So that's going to be the challenge. Who's willing to speculate? Because there's a lot of money that's been on the sidelines that's been sitting, waiting to get into the space. Office doesn't look attractive. Multifamily, as we've seen, Matt, I'm looking at kind of the Green Street Commercial Property Price Index that we covered last week. Money is flowing into the apartment space, not as much into the other sectors because it's seen as a safe bet. And some of the articles I don't think we're going to get to today are looking at, that home ownership rate for millennials is way down. They're not able to buy enough homes. Interest rates are going to help to some degree. It's going to increase the velocity of home ownership and travel and how people are moving in and moving out. I think the quick reaction is, okay, is this going to be bad for apartments because interest rates are going to come down? What we've learned is that when people are moving, buying a house, leasing an apartment, housing demand is housing demand.
I put that in the notes.
Housing demand is housing demand. You said it to me. It's gonna be a shirt.
And another phrase that we say a lot too is would-be home buyers, and there's going to still be would-be home buyers because the housing prices are going to go up.
That's the thing. It's not like interest rates are low and the prices are low also, and it's a great time to buy. Prices are high. They're going to go higher. Interest rates going down are only going to make those prices even higher. And even though your monthly payment may be down, that down payment's not changing. I mean, obviously there's talk about some down payment assistance with the Kamala administration if that ever happens. We'll see if that ever happens. But even as we've talked about that, the effect of that will most likely just be more expensive housing also. So the question is, who can come up with the $50,000, $60,000, $100,000, $200,000 needed for a down payment to buy a house? Not that many people have that amount of cash just sitting around. Some folks are getting help from their parents or whoever.
That's a big barrier.
It's a huge barrier. And we're going to have there are a lot of really nice apartments that have been built this year and the last year. So there's a lot of options for millennials looking for a high-end luxury apartment experience.
It's interesting because I just talked to Jay a little bit about how there could be a little bit of an improvement in home ownership for millennials compared to like Gen X's at the certain age, but overall it is trending lower, and each successive generation had lower home ownership levels than the previous generation, which to me says that this is a huge or bigger trend that it's bigger than the generations. And I would also note that Jerome Powell didn't really say that low interest rates are going to cure the housing crisis. He really made a specific point, like this is a kind of housing supply problem, and housing affordability is not going to go away overnight. There was even one point when someone may have reiterated or said the same question and talked about housing, and he didn't really even answer it. Like, it is a bigger problem, and you can't dial the knobs of interest rates and solve housing. It may make the homes cheaper, but then you got your mortgage rate you're going to deal with, and if you turn down the mortgage rate, that could make the home prices more expensive. So there's not an easy way out except for building more supply, and one of that crucial source of supply is multifamily apartments.
Yeah, very true. Yeah, we're gonna need more supply. That's just without a doubt, Matt.
Yeah.
And where's it gonna come from? There were a lot of other pieces to the summary of economic projections. Some forecasting on GDP. This we're looking at basically kind of the range of where interest rates are going to be going. But essentially looking at the projections for that's PCE inflation. Looking at GDP, as unemployment rate. Here we go. Here's GDP. Look for the rest of 2024. They definitely, and this is the big difference. You see this kind of like this dotted line. Those were June's projections. You see it was a much broader range of opinions where it's concentrated a little bit. There's a very few participants that see GDP kind of really above 2.2%. There's really kind of only like one person that thinks 2.2 to 2.3. One participant thinks 2.7 to 2.6. The vast majority are between 1.8, 1.9, really 1.8 and 2.1. Again, that's a big shift with the consensus being kind of right at 2%, which is where they would kind of like to see.
But
that's
in general,
2024.
it seems like 2024's numbers shifted
year.
down a little bit. The 2024 numbers.
Yep, they've shifted down. In 2025, it kind of similar to where they were last month, although a little bit more to the downside of more participants. I'm thinking that we're going to be in the 1.8 to 1.9 range rather than the right at the 2% handle. But there are still some participants that are going to that believe that we may see slightly stronger growth, kind of in that 2.3 to 2.5% GDP range. And looking out into the future, and as we go on into 2026 and 2027, I mean it's even more speculation. But they're not calling for. Here's what they're not calling for. They're not calling for accelerated inflation. At least when we're looking at GDP. If we actually look at PCE inflation. So this is unemployment rate, PCE inflation. I mean, this is, I think, the big difference where they really kind of dialed it back, where just starting in 2025, the consensus was more in the 2.3 to 2.4% range of inflation. The vast majority of participants now believe that the PCE inflation is going to be right, but at 2.1 to 2.2, much closer to their target of 2%. Basically saying, hey, look, we're slowing down, but we're slowing down right to where we want it to be. Matt, the flaps have been put up. The landing gear is down and the flaps are up, and they're saying that we are getting ready to achieve this soft landing. Again, with even more participants in 2026 thinking that PCE inflation will be right at 1.9 to 2%. Go ahead, Matt.
Just this over, and we noted this before. Just kind of the overarching implication that you caused this. Your high rates have caused this labor market, these labor market troubles. I think he did a lot of work, rhetorically, I think, to characterize the employment market as normalizing and healthy rather than heading towards disaster. And I'm going to mildly agree with him, but I'm a little bit more worried. I think his job is to kind of be more reassuring in this situation. But I think that it's not like there's not like if you look at the numbers, we could be headed for a recession. It seems like employment always seems to like.
Just said, I can always paint you.
That's a good point.
I draw you a map to recession in any market. I think that risk is always there, but again. As Jerome Powell said, and I quote, "Business people doing business things think it's fine."
Yeah, that's a good quote. That's what I also had this quote. The U.S. economy is basically fine. On the other hand, yes, he was reassuring this time.
But he picks his words so carefully. What is basically fine?
Yeah, I know.
Basically fine. It's like he's like it's a qualifier.
He's good at his job.
He's deciding to not call it fine.
Yeah.
What's the difference between fine and basically fine?
And this is another thing too that I thought that it was continually earlier in the questions rather than later. He did not want to be on rails, right? He didn't want to make people think like, oh yeah, we've got it planned out and this is what's going to do. Boom, 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 boom. Look at the dot plot and that's what's going to happen. No, he wanted the idea of them reacting to the economy is an important check. It's an important power that the Fed has psychologically that will maybe like chasten and govern economic behavior just as much as
they want to reserve their power and to be
Yeah.
able to affect monetary policy.
Yeah, for sure.
100%. So just want to bring up again just one of these graphs looking at. We'll do it big so everyone can actually see it. This is again basically kind of we're looking at the dot plot, but it's their projections for the range of the Fed funds rate starting in 2025. And again, this is just kind of lining up where everybody is, just a different way. And I like this again because it shows us where they were back in July and how that's changed. You see, back in July, the consensus for 2025 for the Fed funds rate was really kind of in this 4.13 to 4.37 range that's shaded here. And now we've moved back almost 100 basis points, Matt, between 3.13 and 3.62. That's a big change. Also, in 2026, it's moved back where the consensus now is kind of in that 2.88 to 3.12 range where it was 3.13. Almost basically moving forward rate cuts an entire year, which I think is fascinating.
Yeah.
Then outside of that, who knows? But they're basically going to say it's going to stay around that range, and they don't know. We don't know.
2.5, 2.8 as the
Kinda where
overall
it's gonna
longer run.
land.
Yeah.
So what is this? One thing for multifamily investors that you want to remind, I guess, to take away from that is, again, coming back to that interest rate cap rate correlation, and that. Perfect. So just got the question. So when we see interest rates, on that gradual slope down, again, volatility of interest rates spiking, one day, that can cool the market. But we're looking for like longer drawn out effects. And so the longer effects of interest rates declining over the next couple of years, one would think you'll see a correlation of cap rates also declining over the next several years. And again, a little bit of that has already been priced in with the 10-year Treasury, when it would dip below 4% in anticipation of these cuts. Buyers were coming back into the market. We've talked about a handful of just anecdotes that we've seen just have direct experience with for projects that started getting bid up because of the anticipated interest rate environment. And I think that it's really unleashed a lot of institutional capital, back into the system, and they're going after these deals. Now, what they're not finding is distressed deals. We talked about that. They're finding, what's out there is, newer construction deals, and then, deals that are older and have had some issues, but they're still trading for a premium. There's a lot of what's on the market. There's a lot of high quality properties on the market. The rent growth for those properties aren't really high right now, but you're buying quality properties at a similar cap rate as some of the more workforce housing B and C class assets are trading for, and then some of the really rough distress kind of C and below product. There's just not a whole lot of appetite for right now at all. It's hard to finance it. It's hard to insure it.
And that'll be difficult for affordable housing. That's interesting. I also wonder, you've got to factor in. So what you may be saying is right now they might be pricing in future rate cuts, but then how much are they pricing in, and how much are you going to have to kind of sit with and eat, basically, in terms of like the lower rent growth for about a year before things can realize? And the balance may be overweighted. Things may be overpriced. I think that especially in the kind of fervor of it right now, people may bid up a little bit too much. But that was
and do you change your financing strategy also?
Yeah.
Whereas now, are you more open to floating rate debt? Maybe even going a bridge route where kind of bridge debt and floating rate debt has been kind of like a bad word over the last 18, 24 months. But now, if interest rates are declining, do you ride that wave down of lowering rates, and then as cap rates lowering and interest rates are lower in 2 years, you refinance at a higher valuation at a lower rate, do a cash out refinance. Doesn't seem like the craziest strategy. And in that environment, you could say, well, maybe we don't get an incredible amount of rent growth, but rates are but we're going to be, making more net cash flow because our debt service payments going to decline, and from just the capital markets perspective, cap rates are going to come down. We'll be able to refinance, and so we're going to be able to extract that appreciation really through more, again, capital gains, capital appreciation, rather than really operational performance.
Yeah, because that's what I was kind of thinking about too. Is you get lower rates, and maybe they're pricing in somewhat, but you may be getting in the most optimistic situation. You get more rent growth. You get lower
you could see
debt payments, and then you also get higher pricing or lower cap rates. All these kind of confluence of things that kind of build on each other.
Yeah, and the other piece I didn't mention there is, and I kind of discounted it, is the rent growth, because I think it's reasonable to say that, hey, we're not going to see a lot of rent growth. Things are going to be relatively slow. I think there's also an argument that says, look, once this supply has been delivered, not now, but in a year and a half to 2 years, we actually could see some pretty strong rent growth. Now, when you look back in history and you look back the last couple cycles, after we've gone through a period of negative rent growth, every single time after that, we've seen a spike in rent growth. Now, there's a lot of things that are different about what this cycle or whatever period that we call this, and so you kind of can't count on like the normal things to always happen in a cycle of this happens and then that, and just a series of events. But there is a lot of housing demand, and so all of the ingredients are there for accelerated rent growth. And I'm not saying the rent growth that we saw in 2021. I'm saying moderate rent growth, kind of in that 4 to 6% range. I don't think is off the table. And then so if you do get kind of the hat trick of lowering cap rates, lowering interest rates, and increased rent and higher rents, it could be an absolute incredible time to acquire real estate. But you have to stomach low cash flow, maybe in that first year or two, just to be able to have the chance. So I would say that there is a maybe not higher degree of risk, but there's risk. There's absolutely risk. But what's different now compared to 2023 is that there's actually upside and potential reward.
I know, because we were saying this in 2023. It's like, you just have to wait through this 2023 or wait through 2024, and then but if I had to go back and change, I would say, yes, there is light, but man, it's going to be about a year longer than you think it is. And even when the numbers work, right, even when the debt is right, you're still going to have to wait for the apartment supply to kind of normalize so that things work out that way.
I guess the concern could be because you could say, okay, we bottomed and we're on the upswing, whereas we were still coming down, and we don't know who wanted to catch a falling knife. Yeah. Okay, well, now the knife's like, you've heard the ding, it's on the ground, it seems like it's clear. And I'm just throwing this out for conversation's sake, is, there could be a double dip down. We could see some sort of like, dead cat bounce of where like, all right, we bounce up a little bit, people are excited, and then, some major, so whether it's a black swan or, call the event. Maybe inflation ramps back up and they have to increase rates again, or some sort of
or just considering how slow it's moved anyways. The knife could have fallen. We know that bad thing's over, but it still stagnates for a long time before it actually recovers, because of the size of this of the apartment supply. Like, we are past the worst of it, but there's still challenges. It's still not going to be perfect.
Or maybe everybody brings their property to market, they try to sell, and there's too much supply in the market of properties to sell, and prices start coming down. You can paint this scenario. As I talk through that scenario, it doesn't always really kind of line up with, I think, what makes sense. But I think there is that concern there. But I think the base case is that we've set up pretty solidly. The fundamentals are set up pretty well for the next couple of years, 5 years.
I am super interested in knowing if, first of all, like I don't have like a perfect view of how much of what deal activity is right now. My assumption is that it's pretty low. I wonder if the character of the market does change once deal activity increases. Like right now, it is few and far between. It's kind of a little bit of even though you've talked about like how the broken through, but the small amount of deals that exist mean there's certain elements where it is a seller's market. And so when you get more sellers, how is that going to change? Are sellers going to have a little less leverage because they're not the only guys out there selling?
I'd say it's relatively balanced right now between buyers and sellers.
Yeah.
We could see that shift again to where being much more of a seller's market. It was definitely a buyer's market a couple months ago.
Yeah.
It's much more balanced today. Or back to your earlier question when we were talking about kind of just timing and like what's going to happen before the end of the year.
Yeah.
I think we're thinking about it in those terms, but like if you take like the end of the year out of it, and people are ready to do deals.
Yeah,
and it doesn't, in some cases it has to be done. We got to close it before the end of the year, but unless you have, there can be reasons. They can be tax reasons. They could be, you may have a loan expiration, but you close in December. Sometimes closing mid-January is way better than closing in December.
Yeah.
Who wants to work kind of halfway through the end of December?
Yeah.
You might want to work, but no one else wants to work. So good luck getting anything done between Christmas and New Year's.
Yeah.
But with the next date that I'm thinking about is NMHC at the end of January.
Yeah.
It's going to be in Vegas, and that's where most of the deals are typically rolled out and brought to market. And I know just as conversations we have with brokers talking about our portfolio and maybe something that we are interested in selling, and we haven't been big on selling because it hasn't been a great market. We did sell a property because we were able to get a great price for it, but it will be very interesting if that becomes the rollout and the showcase and figuring out where the market is, and it could be wild.
That's what's so interesting. I completely agree. I am very interested to see how the dynamics of the market change when there's just more activity, when there's more sales. There's still a little bit of fog. There's still a little bit of mystery, and in many ways, it still seems like one deal can characterize the feeling of a market if there's that few of things going on for sale. I don't know. I'm curious right now. Do you think how has deal activity changed since the beginning of this year? Has it increased?
It got really quiet in the middle of the year. I have a sense that it has picked up in the last several weeks or month or so.
Yeah.
I don't think there's been compared to previous years. I still think we're way below on transaction volumes.
Okay.
I think there's been a lot of deals that have attempted to trade. Not that many deals actually have traded.
Okay.
But I think that's going to be changing here in the very near future.
Cool.
Yeah.
Some things I don't know, and I'm willing to learn about.
Yeah.
It'll be exciting, I think, too.
It is exciting. Well, we didn't get to, we've got tons of articles that we were going to talk about today. Obviously, we talked about the most important thing. Matt, we're going to, well, first, where can somebody go? Where can they go to find these articles?
You can log in to www.graycapitalllc.com/newsletter and sign up for the Gray Capital newsletter, and get every week on Thursday and a bonus update on Sunday, the latest, greatest, and best, most importantly, the best knowledge, research, and reports on the multifamily market, commercial real estate, and the economy. It is a free newsletter. It is the best newsletter on the apartment market and the commercial real estate and investing in general.
Yeah, I've had so many people tell me that it's kind of their guiding light for the commercial real estate industry. I mean, we do cover with a strong focus on multifamily, but covering commercial real estate, housing, and the macro economy. It was kind of the newsletter that kind of, I think, set off and inspired a lot of the big CRE newsletters that we see today as well. So yeah, as Matt said, GrayCapitalLLC.com/newsletter. But also, if you're not subscribed to the Gray Capital YouTube channel, this would be a great time to do so. We don't do these lives all the time. Like when we have a new deal, we do live streams, and occasionally when we want to go and have some fun, we will do these live streams. So make sure you're subscribed to the Gray Capital YouTube channel. Thank you for watching this exclusive live stream of the FOMC statement and press conference, and going over the statement of economic projections from the Federal Open Market Committee. Again, thank you